Welcome to The Explainer. Listen, I am absolutely thrilled you're here today because we're taking 18 essential, potentially wealth-changing tips about exchange-traded funds, or ETFs, and transforming them into a simple, actionable playbook just for you. Whether you're literally just opening your very first brokerage account or you're a seasoned investor looking to tune up your portfolio, we're going to completely strip away all that complicated financial jargon. Today, it's all about focusing on what actually drives long-term wealth. But before we dive in, I really have to ask you a serious question. Are you making silent ETF mistakes? Honestly, it happens all the time. You see, even the most well-intentioned investors can accidentally crank up their market risk or quietly lose thousands of dollars to hidden fees over the years simply because they don't know exactly what to look for. Well, today, we are going to fix that for good. We're going to make absolutely sure your money is working just as hard as you do. So, here's our roadmap for today. We'll be hitting 4 powerful phases: the ETF basics, looking under the hood, mastering true diversification, and finally, smart long-term strategies. Let's kick things off with phase 1, the ETF basics. We've got to build that foundation. Okay, let's start with the absolute core concept. What actually is an ETF? Think of it like a prepackaged basket of investments. Imagine walking into a grocery store, and instead of having to painstakingly pick out every single piece of fruit to make a fruit salad, you just grab a pre-made, perfectly balanced bowl. That's an ETF. You buy one single share, and boom, you get instant diversification across dozens or even hundreds of companies, completely skipping the headache of picking individual winning stocks. But hey, here's the catch, and this is absolutely crucial. Always read the fund's actual objective. You literally cannot just judge an ETF by its title. A fund might have a super safe-sounding name, but underneath, it could be using really risky strategies like hidden leverage or complex options. Just take 30 seconds to read the objective so you don't take on massive, excessive risk totally by accident. Now, you've basically got 2 flavors here, and the contrast is massive. Passive ETFs simply ride the market wave by tracking an index. And because it's mostly automated, the fees are generally incredibly low. On the flip side, you have active ETFs. These have actual human managers actively trying to beat the market. Sometimes they do, and that can offer great returns. But you're definitely paying a premium for that active strategy, which means higher fees. You really have to choose the style that matches your specific goals. All right, moving right along to phase 2, looking under the hood. It is time to evaluate your engine. 0.10%. I mean, that sounds like absolutely nothing, doesn't it? But trust me, that tiny expense ratio difference can aggressively eat into your long-term compounding gains over the decades. It's wild how fast it adds up. You want to keep those fees as low as possible, unless a higher fee is crystal clearly justified by highly specialized performance. And when you're looking under the hood, you really must check the top 10 holdings. 2 ETFs can sound totally identical in their shiny marketing material, but when you actually lift the hood, they hold completely different assets. Checking those top 10 holdings shows you exactly what you're putting your hard-earned money into, which is the only real way to understand your true risk and sector exposure. Okay, watch out for this trap because I see investors fall into it all the time. They see a high dividend yield and their eyes just light up. But honestly, a massive yield can sometimes be a blaring distress signal for an unhealthy, struggling company whose stock price is plummeting. What you really want to look for is dividend quality. ETFs holding businesses with rock-solid cash flow and a consistent, reliable payout history. Quality beats a flashy, temporary yield every single time. Another super quick thing to check: trading volume. You want to buy ETFs that trade heavily. Why? Well, low volume means wider bid-ask spreads. That's just a fancy way of saying there's a larger gap between what buyers want to pay and sellers want to accept. Basically, you'll end up paying a hidden premium just to get in or out of your position. High volume ensures your transactions are cheap, smooth, and lightning fast. And look, we've all been tempted by this. But remember, just because an ETF performed incredibly well recently doesn't mean it will continue. It's totally human nature to want to chase last year's big winner. But chasing past performance, that's a classic rookie mistake. Don't chase the trend. Focus on a really solid long-term investment thesis. Which brings us to phase 3, mastering true diversification. Let's go way beyond the surface. Beware the illusion of diversification. You might sit there and think, hey, I've got 5 different tech-focused ETFs, I'm super safe. Actually, scratch that. If you look closely at the holdings, you might realize all 5 of them have Apple and Microsoft as their biggest investments. We call this overlap.
If you have too much overlap, you aren't truly diversified at all, you're just overly exposed to the exact same giant companies.
You've also got to think about market capitalization, basically company size. Large cap ETFs focus on the titans of industry. They offer a lot more stability and steady growth. Small cap ETFs, on the other hand, focus on smaller companies. Now, they offer significantly higher growth potential, but brace yourself because they come with way more volatility. Your portfolio should always reflect your own personal stomach for risk. Now, here's a kind of brilliant, slightly advanced tip for you. Most standard ETFs are market cap weighted, meaning the biggest companies take up most of the space in the basket. But an equal weight ETF, it gives every company, big or small, the exact same slice of the pie. This can honestly give you a hidden edge during broad market growth cycles, simply because you aren't relying solely on a few mega corporations to do all the heavy lifting. To get your risk profile dialed in perfectly, you really have to understand how different exposures work. U.S. markets absolutely dominant and offer strong historical growth, but they can easily lead to overconcentration. International ETFs broaden your horizons, but they introduce currency and geopolitical risks. Sector-specific ETFs, like just buying into tech or energy, offer targeted, massive gains, but equally massive localized losses if that specific sector tanks. Finally, stock-only portfolios can be a pretty wild ride, so adding bond ETFs creates much-needed stability and income, even if they have lower overall returns. Balance is literally everything. All right, final section. Phase 4, smart long-term strategies. This is all about maintaining the machine we just built. The real secret sauce here? The brilliant simplicity of dollar-cost averaging. Step 1, choose your core ETFs. Step 2, invest a fixed amount consistently, say every single month. Step 3, ignore market timing entirely. Seriously, trying to guess when the market will go up or down is a total fool's errand. Dollar-cost averaging completely removes emotional panic, prevents bad decision-making, and naturally smooths out those wild price fluctuations over time. Of course, markets shift. A sector that was tiny might suddenly boom and end up taking over half your portfolio. That's exactly why you need a strict, easy-to-follow timeline. Just review your accounts quarterly to keep an eye on things, and then once every 12 months, simply rebalance your portfolio. Sell off a little of what went up, buy a little of what went down, and get your risk level perfectly aligned with your goals again. It's like a yearly tune-up. Oh, and a super quick note on taxes. ETFs are usually incredibly tax-friendly, especially compared to old-school mutual funds. However, if you start playing around with highly specialized strategies like covered call ETFs, you might accidentally generate a whole lot of taxable income. Always take a peek at how gains are distributed before investing so you don't end up with a nasty, unexpected bill from Uncle Sam. So let's bring the whole shebang together with the core pillars of an ETF portfolio. My absolute biggest piece of advice here, keep it simple. Complexity is the enemy of execution. You do not need dozens of ETFs to build lasting wealth. A remarkably strong portfolio can literally be built from just 2 or 3 well-chosen funds. Prioritize clarity, master your diversification, demand the lowest fees possible, and keep your eyes locked on long-term growth. I'm going to leave you with this one thought. Are you ready to build your simple 3-fund wealth engine today? You've now got the playbook. You know exactly which silent mistakes to avoid, and you know how to look under the hood like a pro. Thank you so much for joining me on this explainer. I really hope this sparked your enthusiasm to take control and immediately apply these strategies to your own financial future. Keep learning, keep growing, and I'll catch you next time.